partner of Cuatrecasas in Lisbon. And we'll try to provide you with a flavor of what the situation here is in Portugal regarding permanent establishments and tax audit. To be quite honest, historically, permanent establishments were not an area of focus of the Portuguese tax authorities when it came to audits. There were and there is a case law coming from the past involving permanent establishments, but they were mostly focused, the cases, on the allocation of cost deductions of expenses and whatnot. Whether or not there was a PE was not really the concern or the issue of the audits. This all changed in 2016, 2017, when the tax authorities launched a set of audit procedures, over a dozen procedures, tax audit procedures, specifically targeting Portuguese non-performing loan servicers as dependent agent PEs of non-resident credit institutions, funds, banks, etc. Of course, in the wake of the financial crisis, there was a large volume of non-performing loans in the books of Portuguese banks, and ultimately this led to an active industry of non-performing loans and servicers to try to recover this debt. In a nutshell, without going into many details, you can see what the typical scenario in the industry was at the time. So you had a foreign company which had acquired the non-performing loan. Typically, this was attached to a Portuguese real estate asset, which led to a further need to local managing the credit and the recovery of the credit. But that's not really the important aspect here. Typically, the foreign company had engaged an independent Portuguese servicer, which provided management and recovery services for the non-performing loans. The remuneration of this servicer included a fixed and variable component based on their performance in recovering the loans. And the big deal here is that the tax authorities regarded or tried to regard the servicers as dependent agent PEs of the foreign companies. Relevant for our talk today, which factors were considered by the tax authorities as signs of a permanent establishment? With no surprises here, but let's run through them one by one. The first one was the remuneration of the servicer, whether or not it was on a net profit basis, or whether or not it meant that the servicer bared or not the risk of its activity. Of course, the more independent the service would be, the higher risk predictably it would bear. The second sign would be exclusivity. If the servicer only really did work for that foreign bank or for that foreign fund, you could make a case that it wasn't really independent. And they made an interesting analysis regarding the total turnover of the servicers. Typically, the control of the activity of the servicer, if there were strict guidelines or instructions that the servicer had to follow, or even to get prior authorization to accept haircuts in the credits or some level of negotiation. And finally, whether or not the servicer had the power to actually bind the foreign company in agreements, in payment agreements regarding the loans, even if this was capped at some cases. So the outcome of those cases was a little bit mixed. Most of the cases were won by the taxpayer due to the inexperience probably of the tax authorities. They, based on formal arguments, they didn't really did they work properly, so for lack of a better word. But in some cases, actually, the tax authorities won, and the taxpayer chose to pay the tax and to assume that it had really a permanent establishment. The lessons learned here going forward, because this issue will probably remain, is that it is crucial to have a proper management of the information that is shared with the tax authorities. This, of course, in this specific type of cases, but it is valid for all PE cases or situations. In this type of cases, you have two entities, the foreign company and the servicer, and you have to coordinate what level of information is given to the tax authorities and which information, so that it is accurate and there is no contradictory information provided. But as a whole, you need to have control, and as mentioned in the general talk, the tax authorities are very keen in going and talking to employees, clients, to check if the stories match up. One important take from all this is that simple denial is not enough. According to the case law, there were cases in which a taxpayer, because it apparently did not have, of course, Portuguese bookkeeping, or so it didn't add a bookkeeping specifically regarding a PE, which of course it didn't think it had existed. So simply there was a refusal to provide information to the tax authorities regarding the activity of activity in Portugal. This led to the tax authorities applying indirect methods of taxation, which are often, as you may know, excessive. And the most important take to learn from this is that actually to provide quantitative information on your transactions or on your Portuguese transactions doesn't preclude litigation on whether or not you have a PE, and actually mitigates damages and keeps the burden of proof on the tax authorities' shoulders, which is important in terms of a strategy, of a tax litigation strategy. A final very important remark here has to do with the need or not of having international exchange of information and administrative cooperation. Actually, according to the applicable to the current version of the directive on administrative cooperation, at least within the EU, this cooperation can actually be bypassed, and in this case, it was actually bypassed because, according to this directive, tax authorities can actually notify directly, if by registered mail or electronically or via email. They can notify a taxpayer directly in a different member state, which means, and they did it, the Portuguese tax authorities did it in this case, which means that they can ask for information, which means that if the information isn't provided, they can take that into account, and it's a fact that the Portuguese tax court would most certainly see as a non-cooperative action by the tax payer, with impact not only on the tax assessment but also in fines and penalties. The concluding remarks here are as follows. I mean, the permanent establishment audits have taken a while to exist in Portugal regarding the existence or not of a PE, but it seems that they are here to stay. Of course, we've listened in the main talk that there are many incentives for the local tax authorities to argue that there are PEs, and budgetary constraints are not no strange to the Portuguese reality. But going into some hard facts, actually the state budget for 2021 amended the corporate income tax code, the Portuguese corporate income tax code, and included provisions that provide us with a scenario in which you can easily see that the action will follow. We now have a service PE provision. Of course, this has to have interplay with the Portuguese double tax treaty network, but we have it in our law for the first time. We have a reduced threshold for natural resources activity, prospecting and exploitation. We have aligned our dependent agent concepts and ancillary and preparatory nature activities with the OECD standards. And now we have a force of attraction rule, which prevents headquarters from acting directly from abroad when they have permanent establishment in Portugal, meaning that the profit of that PE will include also those transactions. So the final remark would be to be prepared. So be prepared, and of course we are here to assist you if you need to, but please review your structures, your contracts, your instructions, even your business models, because it seems that the risk of a PE audit in Portugal is possibly higher than ever, and it's better to be safe than sorrow. And I will see you in the main room. Thank you.